So hello, everyone, and thank you so much for joining us today. I am really excited for this webinar with Daniel from Equity Multiple. For those who don't know me, my name is Chris Lustrino. I'm the founder and CEO of Kingscrowd. We've been around for over 7 years, really with a focus on providing really high-level investment research, education, and all the tools you need for navigating this new landscape of alternative investments available on platforms like Equity Multiple, like Start Engine, like WeFunder, like Republic. We actually have 100% coverage of the Reg CF and Reg A equity and debt markets to date, involving any company that has ever raised capital for their business, which I think is pretty cool. So I have a deep knowledge and understanding of how these markets work. And one of the things we like to do on a monthly basis is bring in experts from different sides of the equation, this time in real estate, areas that we don't cover at Kingscrowd currently, but that we want to educate our investors on to be able to learn about other alternative investments that are out there. So I'm really excited for this conversation. Just so you all know, it is a sponsored educational webinar. And actually, Kingscrowd Capital, our fund, is an investor in Equity Multiple, which I think is pretty awesome. We've always thought very, very highly of the team and have gotten to know the team well from being investors in it. So really excited for this conversation and to dive in on all things Equity Multiple. And with that, Daniel, thank you so much for joining us today.
Awesome, Chris. Really appreciate the introduction, and I know that you and I have had some great conversations before. Want to make sure that everyone got in. So, I see that there's some people in the waiting room. Not sure on that
Sure.
one.
I will, yeah, I will have our team. Yep, I see that. Um, I will have someone on our team manage that.
Yeah.
Um, but yeah, if you want to get started with providing kind of your background and
Yeah, of
um,
course.
that'd
Yeah.
be great.
So Equity Multiple, we're a real estate investing platform for alternative investments. I'm the head of growth over here at Equity Multiple and head up a lot of these webinars and speaking to investors. So I've done a lot of that. Chris and I actually just had a good podcast talking through his story, and excited to share more about what we have going on here. I'll get my slides shared up. Don't worry, it's not going to be a crazy long slide presentation, and hopefully we can keep it interactive with some questions. And I know that Chris will ask a few more. But today we're going to be talking through the case for CRE lending. It's a really interesting market environment. We've got uncertainty with tariffs and maybe some more certainty now with recent trade talks with China and the United Kingdom, but also just uncertainty about where we're at in the market with inflation numbers coming in a little warmer than expected this most recent reading this morning. But first, some background about me and Equity Multiple. As I said, I'm our head of growth over here. We want to provide self-directed investors with a platform to invest in institutional quality commercial real estate opportunities, all on a streamlined platform, which is the high line for our business. I'll be talking through a little bit about Equity Multiple and then talking through the macro environment and why we see an opportunity for commercial real estate lending. But I think first, as a way of just introducing Equity Multiple and who we are, I'd like to just talk through about our background. We were founded about 10 years ago, back in 2015. In the market for offering accredited investors access to things that weren't the stock market, not the bond market. Charles Clinton, who's our CEO and one of our founders, he was working as a private funds lawyer and was wanting to invest in the types of deals that he was doing work on every single day, big transactions with Blackstone and KKR. And he found that a lot of the deals that were, interesting or, that he wanted to invest in were being scooped up or done in these backroom deals. So he linked up with Marius, our CIO, and they wanted to build a tech-forward platform which sort of democratized access to these investments. So they founded Equity Multiple, a platform where you can go on, see vetted real estate opportunities, and really get that streamlined access to a diverse pool of commercial real estate investments. And we've always been very tech-forward. An all online platform, making sure the document process gets a lot done a lot faster. No more paper signatures or anything like that. But it's also interesting because real estate has always been a very fragmented market. And you might be asking yourself, well, okay, I know real estate, I own a home or I invest in an Airbnb or anything like that, but What do I mean by private market commercial real estate? Well, you are probably familiar with your stocks and your bonds. Maybe you've fixed up an apartment or flipped something, or you have passive income from there. But commercial real estate is larger transactions that are held for a commercial purpose. And it's not just retail or office spaces or warehouses. It can also be a multifamily property, multiple tenants beyond a quadplex, beyond 4 units, and you're getting access to the entire economy of real estate. We've got multiple structures of investments that cover retail strips, grocery stores, industrial facilities, but also more esoteric things. Investors might be familiar with the AI craze and data centers, but you can also get access to much more tangible things like car washes and self-storage centers. And as you see there, the returns are driven by the real economy. When we talk about commercial real estate as opposed to stocks and bonds, it fits into your portfolio as a diversification source. It's one of the most popular and one of the longest well-established asset classes as well. And beyond just owning a property, going out and buying a fix and flip or going out and buying a separate apartment, you can also lend against real estate. If you've got your own starter home, you might have taken out a mortgage, and that mortgage is leveraged to enhance your property. Well, instead of just buying a property, you can also lend against that property or lend to real estate sponsors looking to build something or fix up a multifamily or apartment complex. And, part of the difference between the public markets and the private markets, that private market CRE portion, is that these are not traded on an exchange. They're deals that are done between experienced parties. We, have a network of sponsors that we source with, and they're typically illiquid. You're investing for the long haul, typically 3 to 5 years for a commercial real estate equity investment. And, one of the established premiums, the extra return that you can get for holding an investment, is that illiquidity premium. By investing for the long haul, you can see potentially longer returns. And if you've invested with Kingscrowd before into a private equity investment or, a private real estate deal, you know that you're investing for the long haul. You're not looking to trade in and out of these assets because you want to see the business plan go through to the completion. And it also just increases the diversification. It's not just one type of real estate. You're not just investing in a REIT to get exposure to the real estate. You're able to get access to different sectors and property types, different risk and return trade-offs between different deals. And that allows you to build a really diversified portfolio that you can, diversify out of the public markets, diversify away from equities and bonds and the ups and downs in the stock market. Um, I know it's a fair amount of information, but yeah, I think it's an exciting platform. And before we get into the current market macro environment, I was wondering, Chris, how this fits with what you're seeing in the market too, and you being an experienced analyst when it comes to these types of platforms.
Well, listen, I think we're seeing a lot of interest. It's funny as kind of the stock market has had extreme volatility upwards and downwards and sideways, right? In the past couple of months, we've seen consistent investment into kind of the alternative space. And I think it is that fact that, you're not dealing with the volatility, right? You're making these long-term bets and plays, which I think is really, really interesting. There are so many unique real estate investment platforms out there today. And I just want to dive in a little bit on kind of the things that make you all unique in terms of the types of investments that you're making. So when we think about some of your focus areas, could you dive a little more in and A, how you kind of source your deals, and then B and C, when you think about geographic spread of where you're sourcing deals and kind of the industries or areas that you're focused on, is this strip malls? Is this AI warehousing? Is this biotech commercial real estate? What does that look like? And what do you think makes kind of your investments unique to some of the other platforms out there, like a ground floor and a Fundrise?
Yeah, it's a good thing to compare to the space of opportunities that investor has, because it can be a lot. There's a lot of platforms out there. I would say one of the things that we focus on is areas that other platforms don't focus on. So, I talk about the core four investment types, and that's multifamily, retail, industrial, and office. And those are what make up the majority of transactions. And for the most part, we have a lot on our platform that fall into those four buckets. But I think where we're different is we're not sticking just to, you know, just multifamily apartment complexes or just single family home rentals. We do invest in much broader types of investments or partner with sponsors that invest in much broader types, including very differentiated warehouse types, cold storage, large industrial distribution centers that are, key to Amazon's distribution network. Car washes have been a significantly attractive to a lot of investors because, there's not a lot of platforms that are looking at very differentiated types of real estate. The other thing I think is just the types of real estate transactions that we're going after. You know, there's a stratification of the market, a breaking up of the market between large mega market deals, which Blackstone and KKR are doing, right? We're not doing these billion-dollar equity checks. We're not doing large, pinnacle transactions. On the flip side, on the bottom side, which is maybe what a lot of sponsors or smaller platforms might do, is the very retail market. We're not focusing on these small $1 million apartment complexes that, one or two LPs can get together. And that's great if you want to do it yourself or you're focused on a very niche area, but it's not large enough to merit that stronger institutional approach. So between those two layers is really where equity multiple plays and what we call the middle market, that between $5 and $50 million project sizes, the total capitalization of the project, how much it all costs. And what that allows is institutional quality of the sponsorship and the players in the space, but also it's small enough where it's being ignored or neglected by the much larger players. So that really informs our selection and our approach to due diligence as well. We want to be large enough where we know that the parties, the sponsors involved, are going to be very serious, and that the lending partners that we work with are also going to take us seriously. They treat us as professionals. We treat them as professionals. But it also allows us to get that edge on the market. And working in the middle market, it's sort of like, again, akin to stock investing. If you're going after Apple and Tesla and those much larger companies, you're not going to have much of an edge. Everyone prices in exactly what Apple's going to cost, and the market moves very efficiently. Whereas if you go after small caps, if you go after much smaller companies like Cal-Maine Foods, which is an egg distributor, those have very inefficient markets. There's a lot of pricing that might go one way or another because not many people are following it. And I think that's the way we see the middle market, is that it's a bit of a neglected, very fractured, distributed type of investing where local knowledge counts, sponsor quality really matters, and you can still have an institutional edge. And it's large enough where it makes sense for a lot of investors to pool their money, and you still need to have a good syndicate put together.
Out of curiosity, you talked about car washes and AWS kind of warehousing, these different sectors. Are there different return profiles across those, or is it more just about being diversified across different types of things? So I don't know, if the car washing industry collapse, you're not all in on one type of industry.
Yeah, I think again, one of the only, was it Markowitz says the only free lunch is diversification, or diversification is the only free lunch in investing. And I think every investor I talk to, I want to stress the point that diversification really matters, and that's why it is important to get access to different types of real estate. But on that same token, I think also we're much more of a bottom-up investor, right? We want to look at investments and look at the quality of the real estate and look at the quality of the sponsor and see if the deal makes sense in context of its property type, its asset class, and its location, the property location. So we're not taking a top-down view that all car washes are going to be great and all office space is going to be bad. No, I mean we look at the quality of each deal that comes to us. And based on the underwriting and based on the quality of the deal, we can do what's called risk adjusting, the risk adjusted return profile for each deal. So we don't have a hard cutoff of it must be a 20 or it must be 10% cash on cash. Those things go into our equation when we're looking at the quality of the deal. But we like to present compelling deals that we think have strong risk adjusted return profiles, and that'll have really good highlights or key drivers to the deal. And that gets to this idea of the macro environment for real estate lending too, which has a much stronger risk-adjusted return profile than some sort of equity investment. So, if you have any questions, I'd be happy to answer more, but maybe I get into the macro environment now.
Yeah, absolutely. Would love to hear about the macro environment and what you're kind of seeing there.
Yeah. So as I mentioned with, real estate lending and equity, these are two different types of investments. Equity, you're a part owner in a property. It's just like owning a stock. You're a part owner in a company. You're a partner in a real estate deal. You're a part owner of that property. Lending, or the debt side, is where you're lending money to a real estate sponsor, just like a bond in the public markets world. You're lending money, it's backed by the real estate. And when I say risk-adjusted returns, I mean that the amount of risk that you're taking, the downside cases for a debt investment are much more skewed to the upside than an equity investment, where your equity investment might have higher potential returns, but you're also taking higher potential risk as well. But in the macro environment for lending, what we're seeing is there's this large volume of CRE loans that are maturing. In the early 20s, right after the COVID-19 pandemic, the world shut down. In that early period of recovery, there was a big boom in real estate. And even right before, there's a big lead up in real estate. And what we saw is there's a lot of CRE loans that are set to mature right around the mid 20s, 25, 26, and so on. So when you've got a lot of this CRE maturity wall coming, right? There's nothing maturing, and then all of a sudden, a lot of loans maturing at once. That's a pretty crowded space. So being a lender in that space and having the capital stored up to where you can start lending makes the pricing power much more in your favor. When you've got a lot of people wanting capital and you've got that capital and not a lot of other people have it, that's just a classic supply demand imbalance. And it's particularly in a lot of distributed sectors, right? It's not just in fix and flips. It's not just in these large office deals. It's across every sector. So you can be very choosy as well. So when you've got that large supply demand imbalance, but also it's a broad spectrum of imbalance, you can be very choosy in the sectors that you're looking for. Also, I think with our platform, it allows us to be much more conservative with our lending. That supply demand imbalance again creates an apartment to be choosy. And when you're able to be choosy, you can set the terms such that you've got really conservative LTV, or loan to value ratios. The amount of money that you're putting out is a much smaller portion of what the actual property is worth. We've seen some markets where the values of properties have declined significantly, declined both from their original cost to build and also from just the last trade price that they were at. And when you see that decline and a bottoming in the market, it allows you to get really attractive loan pricing that it's highly unlikely in our view and in my opinion that real estate prices could decline significantly more. It's just the same thing again with stock investing. If Apple were to drop 10%, what's the likelihood that they continue to drop 10%? Same thing with a housing price. If housing prices drop 30%, what's the likelihood that they're going to continue to drop another 30%? So getting in on that bottoming market provides just that enhanced downside protection. And the last is something that's been carrying forward since the global financial crisis, is these regulatory constraints, right? Traditional capital sources, and it's across the board for traditional capital sources, are very scaling back how much money they're able to put out, or how much money they want to put out into less well-established lending environments, so less well-established capital sources. So traditional banks might want to lend to very well-established business plans on established property types or collateral types, whereas there's more nuanced types or areas of the market where it's not as well understood by traditional big banks, where they pass on the deal on its face rather than doing the work of understanding. And that presents an opportunity. There's still sponsors that are looking for capital to refinance their loans that have, maybe it's a tertiary market, something that's not New York or Los Angeles or Miami, or a different type of asset where it's not just a very clean and ordinary apartment building. So in those instances where they need the money and they just can't get a traditional bank loan, it prevents an opportunity for us to provide that financing as a lender. And also because of that service, we're able to get a premium on the pricing. So we're able to get potentially more return than they might get at a traditional lender. So again, you see these three driving forces, which allow us to be choosy, allow us to catch asset prices when they've bottomed or close to the bottom, and a constrained market lending environment where we're able to step in as a lender of sort of last resort and get premium pricing for quality real estate. And all of this, again, is tied together with what the real estate market is doing right now in the interest rate market. The Fed is still in a wait and see holding pattern, but this environment for interest rates is just higher for longer. So any reduction in interest rates has really spurred real estate sponsors to look to refinance and get more attractive lending. So it provides us, again, motivated buyers of lending, and we're a willing seller of premium return lending products.
In terms of folks that you kind of compete with in this segment, you kind of say a lender of last resort needing to refi, those types of things. Are there a lot of players out there competing with you, or do you kind of have that nice niche where it's fairly easy to win deals if you want to win those deals?
Yeah, there are some competitors. It depends if they're going to. It depends on the size of the deal for sure. There are a couple of niche lenders in the middle market lending space. But again, this gets to, what area we're looking at, which is the middle market. If they're large enough to go to someone like Blackstone or Apollo or KKR, they're just going to get a private market loan from one of those sources. But the smaller you get, the less likely you're going to have a traditional lender that's willing to service this. Or if it's strange type of collateral or not well understood collateral, you're just not going to be able to get a Fannie or Freddie mortgage because it's not multifamily. So there is some competition. I don't think that we're losing deals on pricing very often. We are rejecting a lot of deals just based on how the deal runs or just a timing issue with the deal. And our pipeline is incredibly full. We're hosting another webinar this evening for our Ascent Fund investors. And Peter Palladino is every month, every quarter that we've had one of these has been talking through how competitive the pipeline we're having and just how attractive of the real estate that we're able to get because just the lending market is in our favor right now.
And then in terms of actually funding these deals, I think a lot of people know crowdfunding is like there's an opportunity and then you try and fill up that opportunity, right? Are you all kind of doing this off balance sheet or through a fund product and then backfilling it? How do you kind of manage that process to get these folks their funds quickly?
Yeah, that's an excellent point, and actually, it's one of the differentiators for us as a company in the space as well, which is we do give surety of funding to the sponsors. So whether it's on the equity side or the lending side, like we've been talking about, we commit to a certain amount, and the sponsor knows they're going to get that money on the date that they need it. There are some platforms that when they syndicate to their crowd of investors, there's uncertainty around how much they're actually going to get. And that's one of the reasons why sponsors like to work with us is because we do give surety. And the $1 million question, or sometimes $30 million question, is how do we give that certainty? So we raise money from investors in a few different ways. The Ascent Fund is one source of capital for our borrowers. The other is our balance sheet, our Alpine Notes balance. We raise money through that facility and then syndicate down to retail investors on our platform. So the Ascent Fund, retail investors, our balance sheet, and then also we have some credit facilities that we use to enhance the yield on the fund and the loans. So we put together a book of investors, you might call it, and we've developed relationships with our debt team with a lot of third-party financing providers, which allows us to again have good quality relationships. They give us relationship pricing in a way, and it again gives us that surety of funding to the borrower, which makes them want to come back to us time and again.
Love that. So I think it's a good opportunity to go into the Ascent Fund if you like. And I just want to say to folks before you hop in there, if you have questions, please drop them into the Q&A section. And once we get through this next section, we'd be happy to start answering some questions as well from the crowd.
Great. Yeah. I'll skip past these. You can see just again this maturity wall that's developing over the next 5 years or so. This is billions of dollars of real estate or real estate loans that are coming due. Here again, you can see just the spreads have widened for commercial lending. So just the premium that we're able to get for commercial loans is there. And I'd be happy to talk through this more with anyone on the back end. But now we get to the punchline, which is the Ascent Income Fund. This is our fund where we offer investors the opportunity to invest in a diversified pool of commercial real estate senior mortgages. It's what we see as a nice building block for a portfolio, a cornerstone investment. Um, the Ascent Income Fund was launched close to 2 years ago. It was back in August of 23. Wow, it's been almost 2 years now. Yeah. So we're coming up on 2 years with the fund. It's really focused on things that a lot of investors want, which is attractive yield, low capital stack position, so a more safe position for an investor, or more conservative investment, I shouldn't say safe. It is also offering liquidity options, and it's a fund, so you're getting diversification. So I think those major building blocks for an investor, what their checklist items are, we tried to provide in an attractive fund. It's again, leveraging that middle market experience that we have, leveraging that middle market position, and providing what we see as the security of senior lending. Senior lending, as you can see in this chart, as you can imagine, all the capital in a real estate project in a stack. Senior debt is first payment priority. It is the first one to get repaid, and it's what's considered the safest position of the stack because it has payment priority. Before anyone else gets paid back, the senior loan has to be paid back with its interest. We're targeting a 10 to 12% return paid quarterly to investors. And after 1 year, there are liquidity options. So you're able to submit for a redemption and get your principal back with all that interest. It also offers dividend reinvestment. So if you just want to compound the interest, you can do that as well. And it's priced at a $20,000 minimum so that you can access it. And I think given the fact that it has 5 or I think 6 loans in the portfolio now, it's a pretty good deal to get access to 5 different loans for only $20,000. So I think it's, again, that cornerstone that you're trying to get at with your diversification. We've done, billions of dollars of loan opportunities that we've sourced since, 2022. And we really narrow that down to a very narrow set of actionable deals. Overall, in our platform, we only look at 5%, where we only offer 5% of the deals that we see. So every 100 deals that come to us looking for capital, only 5 of those deals make it onto the platform. So we're very selective when it comes to the types of opportunities that we're looking for. In the fund is 100% first mortgages, senior loans on the property. And overall, we're falling in line with multifamily and industrial as the major capital sources, but we've also looked at retail and office and some strip centers as well. And the current fund allocation right now is in 4 different asset classes. As I mentioned, multifamily and mixed use are 2 large ones, but also very differentiated as an assisted living facility and also a hotel asset down in DC. And geographically, as you asked before, Chris, we've got spread across the East Coast for now. We've also looked at offerings or opportunities in Portland and in the Midwest as well. I think we're looking at a Milwaukee deal right now. So we're fairly geographically diversified, trying to diversify our property types as much as possible. And as I say, the biggest thing that we're looking to get at for investors is diversification with a single step. Most of the investments are in that acquisition phase. I maybe should talk briefly about the types of investments that we're looking for, the type of business plans that we're looking for. With the fund, we're not looking to put out money for new construction, so no development loans or ground up development loans that we're looking at right now. And we're not looking for heavy value add right now. What we like to talk about is bridge financing or stretch financing, as it might be called. So in a real estate project, you have at times you start with a value add project where you're buying a property and looking to fix it up. It needs new finishes, new countertops, whatever it is, and you get a loan for that. Once you've completed that construction phase and start leasing up the property, the sponsor will typically refinance that loan into much more permanent financing. Between that initial financing and that permanent financing, there's often a gap between the time that they have completed the construction and before they've completed enough of the lease up where it's stabilized. So what Equity Multiple does is we fill that gap with a bridge loan. It bridges the gap between these two financing methods. So we can assess that it's been a de-risk property because the construction is already done. And we know that the sponsor, or assess that the sponsor, is on track to complete its lease up. So we are pricing that gap to be fairly low risk, and we know that's going to be a short time, typically between 18 and 36 months that it's going to take for those sponsors. And in that time, they will pay us back and with interest, and we know that our loan is going to typically be de-risked over that time. So in these scenarios of acquisition or refinance, it's mostly in those gap financing periods where they just need a shorter term loan in order to complete their business plan or start their business plan, and look to replace our financing with cheaper, more attractively priced financing for them within an 18 to 36 month period. And that about covers it for the Ascent Income Fund. It's open for monthly funding rounds. So each month, investors can get access to the fund. You can add money over time as well. So after the initial $20,000 minimum, subsequent investments are only at $5,000. And it pays a quarterly dividend and offers liquidity after a 1-year lockup.
Awesome. Thank you very much, Daniel. A few questions rolling in here that I'd love to get to. First off, how do you assess exposure to construction risk or development phase projects in the fund's loan portfolio? And I know you hit on a little bit of where you focus, but beyond that, how do you think about that exposure?
Yeah, 100%. It's one of the first things that we look at in the project is how far along is this business plan? We have one down in Georgia where it is a development project, but it was on the not even back half, but like back quarter of its construction timeline. So it wasn't, the dirt on the ground and we're giving them the money. It was they needed to bridge or stretch a little bit more financing to complete the project. So there is some of the assessment up front where we don't want to be in the initial construction phases. We want to be, just at the finish line, just pushing the ball over the hill so it can complete. When it comes to something like a value add, same thing. We don't want to be at the initial start of the value add. We've got one of these in the acquisition side where it's not an acquisition in order to refinance. It's an acquisition to convert to condos. So it's 100% completed. All the renovation, it was just recently renovated, and the previous owner wasn't able to, get the type of lease up that they were looking for. Our borrower came in seeing it as an opportunity to convert the property into condos instead of leasing. So they bought it already and started going down to complete the lease, complete the book of tenants who are looking to convert, and then go to the condo board and convert. So there's no construction risk in a lot of these. One of the more complex ones was the senior or assisted living facility where it was a significant conversion. However, in that one, the business plan was not to provide construction financing for them to complete the renovation and conversion. The business plan was to provide financing so that they could hold the property long enough until it was approved to be converted, at which point they had financing lined up for permanent financing. So there's these nuances between, whether it's 100% just looking for construction or 100% not looking for construction. And those bridge scenarios, those gray areas where we can fill in the gaps, I think are where we see the opportunity in a lot of these cases. And by the way, that assisted living facility in New Jersey, we did get the township's approval and they're looking to pay off the loan already. So, a very nice success story.
Yeah, absolutely. How are your loans priced today relative to SOFR, and what kind of interest rate floors or hedges are in place to protect LPs? And for those who don't know what SOFR, if you don't mind defining that, that'd be helpful.
Yeah, of course. I love the deep questions, the very nuanced ones. SOFR, as it's called in the biz, is the secured overnight financing rate. It's what replaced LIBOR, the London Interbank Offered Rate. And that's just a reference point for floating rate debt. Floating rate debt meaning that the price or the interest rate on the debt changes on some set period, usually 30 days or 90 days. SOFR is the reference rate that most loans are priced at right now. And usually you'll have what's known as a spread to SOFR, SOFR plus something. That spread is typically what you're really concerned about. Our loans, one of the most recent ones was SOFR plus 595. So SOFR's around 4.5 right now. So what's that? 10 and a half, call it 1045. Um, and the first question that a lot of people will ask is, okay, if you're pricing at SOFR plus 595, you're getting 10 and a half. How are you delivering a 10 to 12% return to investors? And that's through the use of leverage. So one of the points of the fund is that we do have third-party financing, and that financing will provide leverage of about 50% on the loans. Our fund will pay that third-party financing less than the borrower does. So there's a spread between the spread that's being picked up, which allows us to increase or enhance the yield on the fund. Um, you asked also about SOFR floors. And for anyone that has never worked with floating rate debt, um, floating rates can move in your favor, meaning that if the SOFR goes up, you're making more money, but can also work against you, meaning that if you lent out at SOFR plus a spread and SOFR goes down, you're now making less money. So you want to have what's known as a rate floor in place to prevent the interest rate going down too far. And most of our loans are going to be priced with the floor at whatever SOFR is struck at that time. So I think most of our loans are struck with a floor of 4.5. And the ingenuity of our debt team also is that a lot of our third-party financing does not have a floor or is fixed rate, meaning that although uh, the amount that a borrower is paying us can never go down too far. The amount that we're paying then to the borrower or the third party financing can go down. So we're actually increasing the spread as rates go down, which enhances the yield on the fund. So we're in some cases protected if rates do fall or if rates were to change. And if rates go up, we're just still going lockstep with SOFR, which is obviously very good for the fund. And then in terms of rate caps, we don't, to my knowledge, have any rate caps on the borrowers right now. Given the bridge situations and the short-term nature of the loans, this isn't really permanent financing, so it's not like a heavy value add where you would be concerned about the sponsor not being able to pay the debt. And it's similar to situations that we saw in 21 and 22 where rates really started to blow up. But these bridge situations, 18, 24 months, it's not as, I think, critical to have that rate cap in place to protect the NOI.
Another question here, and I think you've hit on some of this, but I just want to make sure we capture all of it.
Mhm.
Are your loans typically secured by stabilized cash flowing assets, traditional assets, or land? And how does your underwriting differ across those buckets?
Yeah, very good question, and it does depend. You don't want to treat it all one size fits all. Again, we don't lend against land. We do lend against some in place developments, so in progress developments. We do our underwriting based on an interest rate reserve model. So we do set an interest rate reserve for most of the loans that we're pricing, even in cash flowing situations. Um, because we want to be very conservative when it comes to our assessment of how this underwriting will go. We take the model, we underwrite it 100% ourselves, and look at what we think the most likely downside case is going to be for a property. Not the catastrophic case where no one laces it up, but most likely, it's going to be slower than expected. Costs might overrun a little bit. And we look at that and say, okay, what is the likely leasing scenario and what's the likely rent that's going to be achieved, a fair amount of rent that's going to be achieved, and what's the leasing velocity for some of these properties in order to, and what's the NOI that's going to be generated from that leasing velocity. And based on that, we see what the gap is between NOI and the interest that's required, the debt service that's required each month. And we tally that up and assess what the interest rate reserve is. And that interest rate is held separately. And any delta, any difference between what's owed to us and what the sponsor is able to pay comes out of the interest rate reserve. And then also we typically will price a minimum interest period. I think in the last couple loans, it's been an 18-month minimum interest period, meaning if the sponsor for some reason refinances early or pays off the loan early, we still will receive at least a set amount of interest on that loan so that we ensure that we're not getting paid off too early. But yes, it does depend on the property type, depends on the business plan. And we look at each property type very differently, right? Leasing for a multifamily property where you're typically getting a 1 year lease term is very different than underwriting for a hotel where you're going to be having daily turnover and fluctuating occupancy based on the time of year. And of course, it's still different than a condo conversion or a construction where you're not really getting any NOI or income for the first few months of the plan. But then as you lease up, you get further and further along and can see more cash flow coming from the property. So yes, we look at each property type differently. We're not assessing, just risk based on the metrics, but we're assessing also ways to mitigate those risks, which is not just the price of the loan as referenced by the rate, but also the interest rate reserve required, the debt service coverage ratio that's required for maintenance on the property, and any other refinance assumptions that are being required, and the price of doing those changes to the loan.
Another question here. Can you share more about the significance of the CRE maturity wall? And does Equity Multiple have any precedents on how to navigate this opportunity?
That's an excellent question. It's one of these very chunky things that we um, all are experiencing from the post-pandemic period. Um, Although there's a large boom in commercial real estate investing and real estate investing overall, right? A lot of people doing fix and flips, Airbnb arbitrage, all that jazz. It also was a chunky period for interest rates. Interest rates went from 0 to 4 in less than 2 years, which is unprecedented. Like 400 basis point rise. So you've got a lot of loans that are um, just coming up with very attractive interest rates that it's uncertain what the interest rates are going to be in the next couple of years. We could probably assess that for the next year, it's going to be fairly high, and unless there's some sort of recession. But even in that sense, um, I'm uncertain about which direction the Fed will choose because it's looking more and more, at least in one of the scenarios, that we're going to hit some sort of stagflationary environment where you're damned if you do, damned if you don't, right? Like, if you cut rates, then you're getting inflation, but if you don't cut rates, then people are unemployed. So, it's really hard. And I don't know which rock you'd rather sit between. Um, but in cases of the maturity wall, it's a bit of a wait and see with a lot of these sponsors. Towards the beginning of the year, originations were very dry. Like it was very difficult to originate some of these loans 6 months ago. Part of it was people were waiting for the election. Part of it was people were waiting to see which direction the Fed went with interest rate changes. Um, but any certainty that we've seen has immediately led to price action. And what we're seeing is that these borrowers in this maturity wall are, I think, very sensitive to any change or any signal that they can get. And they were kicking the can down the road until all of a sudden, inflation came in very different and the interest rate environment was not changing as quickly. And they immediately came in and we saw a lot more price action with or deal action with our borrowers. So I think that the wait and see or the patience that we've developed is important and something that we've learned a lot about. But it also is going to benefit us in the long run and being choosy, as I say, in those deals.
Another question here. Have any of your investments defaulted? And in those cases, what has been the recovery multiple?
Yeah. So for anyone who'd like to reference, because I'm not going to go through our entire track record on this call, we do offer an entire track record download. Just go to equitymultiple.com, look at our platform for the invest page, and you can, I think it's the top right-hand corner for the article cards, is a link to download our entire track record. We really pride ourselves on the transparency. It's certainly an ongoing development process to become more transparent and more available to investors. But We've been recognized as number one or best in transparency by Investopedia, I think. So if you'd like to go through our entire track record, it has every exited deal that we've had. So you can see the wins, the losses, and property types and capital types as well. No senior loan in the fund has defaulted. We've not lost principal on any of the loans in the fund. Any principal losses that I'm aware of were mezzanine debt. So mezzanine debt is lower in the capital stack than senior debt and has payment subordination to senior debt, meaning that's paid back second. Uh, those times that we did lose money on those mezzanine debt investments were as far as I'm aware, related to COVID-19 type deals. One was an old folks home where all the old folks moved out and there were no residents. Another was I think it was a courtyard out in the Midwest where, again, hospitality really got hit hard by the pandemic, especially in secondary and tertiary markets. So yes, we've had some mezzanine loans that have lost money, but in terms of the senior loans, like the fund is invested in, those investments that we've made with the fund have not defaulted or lost principal. But again, you can see the recovery percentages or multiples with our full track record on equitymultiple.com.
Great. Um, Another question here. Can I, as an investor, utilize my IRA funds to invest on your platform? And is there a specific IRA I need to use in order to be able to do so?
Yes, and no. So yes, you can use your IRA. All of our investments are eligible for IRAs. One thing to note, for those that are not aware, and even for the original question asker, if you're not aware, um, IRAs can invest in commercial real estate properties through a self-directed IRA. There are some investments which IRA investors might not want to invest in with their retirement money because you incur what's known as um, unqualified business, was it UBTI, unrelated business taxable income. For the case of the Ascent Income Fund, it is all senior mortgages. It is a REIT, so it is a K1 issuing fund. However, the REIT washes, as an accountant once described it to me, the income and makes it so you don't incur UBTI with your IRA. So I can't give tax advice or retirement advice. However, I think that it is an attractive fund because you get diversification and don't have to deal with any of the tax implications of other K1 investments that you might have with an IRA. In terms of custodians, as I mentioned before, it does have to be a self-directed IRA custodian. And that doesn't mean self-directed like you're going to Schwab and choosing your stocks. Self-directed is a very specific type of custodian. And there are custodians like Alto IRA, Strata, I think Equity Trust, which is combined with Inspira right now. The one that we do most business with and the one that's most seamless, where we call them a preferred custodian, is Alto IRA, ALTO. So if you have an account with them, great. If you have an account with another custodian, that's fine. Just reach out to my team and we can help walk you through the setup there. We're fairly open architecture as I describe it.
Awesome. Last question I have here. Is there a way to utilize the 1031 Exchange Act rule in order to roll over my capital gains taxes to be deferred?
It's an excellent question. I've got a lot of investors asking about that, especially after the bite of April 15th. At this time, we don't have anything 1031 eligible on our platform. We have done some DSTs, Delaware Statutory Trusts, in the past. Specifically for the Ascent Income Fund, no, because it's not an equity to equity transaction. But there are some times that we've done Delaware Statutory Trusts or tenants in common structure for commercial real estate equity investments. As I say, not right now. If there's a large investment that you're looking to roll over in the multiple millions, reach out to us and we'll be happy to try to put together a bespoke transaction for you. And also keep a lookout on our platform. We do plan to offer some 1031 eligible investments in the future.
Awesome. Last question here. And I don't know if you can answer this one, but I'll throw it out there. Market specific question. What's your current view on the Charlotte MSA and surrounding submarket, especially as the supply pipeline starts to taper off? Are you seeing healthy fundamentals from a credit perspective or any early signs of stress among sponsors or senior loans in that region compared to other submarkets?
Yeah, we've had a couple of investments in the Charlotte area. Nothing too scary right now. I think actually, was it in the Charlotte area? Was it Poindexter? I think we had a development that we were looking at out there. Um, I don't have any very specific questions right now. I want to look at some numbers before I answered very specifically. And I'd be happy to. If you want to reach out to me, my email is daniel@equitymultiple.com. Actually, I'll just drop it in the chat here if it'll make it easier. Sorry, I'm a little technologically.
No problem.
Yeah, let me stop sharing. I'd be happy to reach out to anyone uh, on the webinar here and just chat through any of this. Let me show chats. I don't know if I can send it directly, but let's see if that
Yeah, we
works.
can certainly provide it to folks as well. Yep, it looks like that went out here.
Yeah. So yeah, anyone who'd like to, get in contact about a question that we really didn't get an answer to, or what you wanted more details, or something like the Charlotte, where I'd be happy to, do a little research and have a more in-depth conversation. And then for anyone that's interested in signing up, you can go to equitymultiple.com/ I think it's boost. If you go to that website and sign up, you'll get a 1% performance boost applied to your first investment with us. So, if it's a 12% return for that one, that will boost that first year return by 1%. So it'll turn it to a 13. Just as a way to sign up. We've got a lot of smaller investments too, if you'd like to sign up. But I think information-wise, I'm happy to provide anything. Even if you're just interested in talking about the markets, please reach out to us. And I'd be happy to talk through our thoughts on the market and how we work as a platform.
Awesome. Thank you so much, Daniel. And, thank you everyone for joining us today for this conversation. Thank you for your thoughtful questions. One of our focuses, right, is really finding those best in class across the market, across these different asset classes. And I've always really thought very highly of the Equity Multiple team. And what I like is they have a long track record. They've been around for a long time. They've gone through some of the ebbs and flows of the market over the past many years, including COVID. We've seen many of the real estate players come and go already. And these guys just keep chugging along, which for me, I like when there's that stability of the business right over a longer period of time. So anyway, if you're looking to get into this space, I think there's a really unique one. And I certainly appreciate the diversification approach and the opportunity to invest in their diversified fund products. So definitely, shout out at us and let us know what you thought of this event and if it was helpful and help you kind of decide to invest in this asset class or utilizing Equity Multiple. And thank you again for your time. Feel free to utilize the links that we just dropped in the chat, and we will be providing a follow-up as well if you want to watch it back, or reach out to Daniel for any questions, or simply sign up. But Daniel, thank you again for your time today. I really appreciate the conversation.
Yeah, appreciate you hosting me, Chris. Always good conversation.
Have a wonderful day, everyone. Thanks so much. See you next time.